All right, so let's just start back with our regular thing again. Okay, we have let's do our assets equals liabilities plus equity. But first we must get there, right? We start with our income statement. Income statement is what? Revenues minus what? Expenses, right? And that gives you some what? Income. Then your next statement is your retained earnings, which is going to be it starts with my what? Beginning retained earnings plus add income. That's dividends. And that's going to end with my what? End retained earnings. Where does this come from? Where does this income come from? Income statement I just had, right? And eventually everything's going to go into my, which is going to be comprised of what? Assets equals liabilities plus equity. And I want to make me some what? T accounts. How do I show an increase in assets? What about liabilities and equity? All right. Retained earnings is going to eventually end up in your what? Equity. So how do I increase my retained earnings? And now think about it. My revenues increase my retained earnings. So I show an increase in revenues using the what? Credit. Good. My expenses, which are different from dividends, are both going to decrease retained earnings, which means I show an increase in expenses using a debit. Good. That's how we set it up, right? I did the same thing I asked you to do before we start doing the problem. Now I got that locked in my head. I'm ready to go. All right. We're going to start off with someone issuing common stock for $24,000 cash. Remember, all assets are financed using what they say, assets equals what? Liabilities plus equity. So all assets are financed using either a liability, you own the bank, someone, or equity, my own funds, okay? So if we issue common stock for cash, I'm going to receive some what? Cash. Cash is a asset, so I show an increase in assets using the what? Debit cash. All right. I'm issuing common stock. I'm issuing ownership. Ownership stock is a what type of item? Equity type item, right? So how do I show the increase in equity? Credit. All right. So credit common stock. Abbreviate common stock. And that was for how much? $24,000. All right. Any questions? All right. Now, I issued stock, didn't quite have enough money. So what am I going to do? I'm going to obtain a bank loan for $7,000 using the notes payable. If I get the loan, that means I'm going to the bank to get some what? Cash. Cash is a asset, and I show my increase in assets using the what? Debt. But this time, instead of issuing stock, I'm going to borrow some money, so I created a notes payable, which is a liability, and I show an increase in liabilities using a credit. Notes payable. For $7,000, right? Okay. Still good? All right. With all that money, I'm going to pay $11,000 cash to buy some equipment. All right. Equipment is a what? Asset. How do I show an increase in assets? Good. And I pay for it using cash, so I decrease my cash, which is an asset, by what? Credit. Good. For $11,000. Now, what happened to my assets? Did they increase, decrease, or no effect? No effect, okay? It's all in that same category. Same pool of funds. Yes, sir?
So, like, if you wrote that backwards, what was that? Like,
It means you're wrong.
yeah, well, I know that, obviously.
No, I mean, if you write it backwards, that means that It probably means, now you have to just kind of go with it. It probably means you sold the equipment for cash.
So it
Or
can't.
you sold some type of equipment for cash, yeah.
It can't go the other way.
It's just a totally different meaning. It's like you got a football jersey on, this one is one color, that was another color. Same number, it just means that you go to this school or this professional team, like that. Okay, so yeah, it's wrong, but just think about it. If you have multiple choices, think about what that's telling you. That's what you're doing right there. Okay, yes, sir.
Can you explain that again? Like when you say use the cash and then you say increase your assets.
Okay. It said purchase equipment for $11,000 cash, right? Correct? So I bought some equipment. Equipment is an asset, and I always show my increase in assets using a debit. First part. Second part, I use some cash. Cash is an asset, but since I gave away cash, I decreased my cash. And how do I show a decrease in assets? Using a what? A credit. That's the journal entry part.
But let's say you gotta take a loan to get that equipment. Is that
Okay, so say you bought that equipment using a loan, good deal. Let me make you one better because the same type of problem is coming up. Let's say I bought that for $11,000 and instead I only paid $3,000 and I had to take out a loan now. A loan, no, we're going to borrow from a bank. So notes payable is a what? Asset, liability, or equity? Liability. How do I show an increase in liabilities? With credit. So now I just change that, or in this case just add notes payable for how much I borrowed. I borrowed $8,000, right? So does that kind of help you out? So you're gonna have, I think it's number 6 or something like that. It's gonna come up kind of similar, but that's the way. That's what you call studying, and that's a good job. You thought about it. You took it and said, well, what if? Anytime you start doing what if, you study and you getting ready for that next level. It's a good question. Everybody good? Now, I'm going to pay $1,200 cash for rent. Okay, so I have rent coming up. I have to pay for it, right? With rent, I have created me a type of what? Expense. Remember, an expense is a using up of assets, right? In short, I'm using up cash. We usually associate the rent with whatever it's associated with. So rent, expense. And I'm going to pay it using cash. Cash is a what? Asset. $1,100. Now that expense falls under assets, liabilities, or equity. Equity. And how do I show a decrease in equity? With debit. There you go. So even with that right there, let's say you just have just that question in a multiple choice or whatever. All you do is you start thinking back to different types of journal entries I had. So when you say, not you say, but sometimes you have the question, should I study more problems or should I study more theory? They kind of go hand in hand. You can use one to get the other. Sound good? Yes, sir. You got a question? Okay. All right. Now I'm going to pay $1,450 for some supplies. Supplies is a what? Asset. I increase my assets with a debit. All right. And I pay for them how? Cash. Okay. And let's do with cash. Sound good? What's the impact on assets? Nothing. I just switch one type of asset into another hand. That's all it is. I'm the same person. Now, if I give it to you, now my assets are decreased, right? But as long as I'm switching them around, it doesn't really matter what it is. It's still the same amount, okay? It just changed order of liquidity. For instance, it's still, you have both as current assets, right? But it's going to, you have to at least, you have to kind of sell some supplies if you want to get some cash back. So it's best to have that cash if you're looking for to pay bills like next month or something, okay? Next, we're going to purchase $600 of advertising on account. We let the marketing majors make up, how many marketing majors we got? We're going to let you make us some. Now, all right, so you purchase some advertising on account. We're buying it from you, okay? So it's an expense to us, right? Advertising expense. All right, how do we show our expenses, again, in terms of, do you debit or credit to increase your expenses? Debit. Advertising expense, okay? And we did this how? On account. That means that we didn't pay you yet. So if we had expenses on account, we didn't pay cash, that comes back to the question you just asked. That now creates an asset, liability, or equity. The liability, right? So how do I show the increase in liabilities? With a credit. Okay, sound good? Okay, for how much? 600. And if you get lost right there, all you have to do is think assets equal liability plus equity. Okay, yeah, we feel good about expenses, and we know that expenses increase with that debit, right? But then that liability, well, yeah, the accounts payable. Well, okay, I know it falls here under that right there. Now I just have to remember my regular rules. I increase assets with the what? I increase assets with the what? With a debit. So every liability is increased with the what? Credit. So now I credited my accounts payable here, and I debited my expenses there. Sound good? It sound good right now? What you got? Huh? What you say? That's all it is, just a different language. The one that the bank wants. That's why I learned how to speak it. I like money. That's the only reason I care about account. No, I just care. But seriously, you know, that's all. You said it right. It's just a different language. Let me see if I can translate it for you. Tell me something.
All right, so your advertisement expenses, right? So your expenses always lie on what? The equity?
Yeah, expenses are always going to fall on equity. Going back to what we did at first with the revenues minus expenses, all that income is going to go to retained earnings. I'm going to abbreviate from now, retained earnings. And that retained earnings eventually goes to what? To the equity part, right? So, let me ask you this. Do retained earnings increase equity?
Yes.
Yeah. So, anything that increases retained earnings is going to increase equity too, right? Anything that increases equity is going to, anything that increases retained earnings will also increase equity, right? So which one of these increase retained earnings? Remember, retained earnings add income. So I can only have income if I have more revenues and expenses. So revenues increase retained earnings, right? And retained earnings increase equity. Equity has a normal what balance? Credit, because you increase them that way, okay? So that means retained earnings will also increase with a credit. But expenses are going to lower it, which means you have to do the opposite. And that's why we debit the advertising expense. Sound cool? It's one of those things they say, only difference between me and you, I just did it a few times. But if you kind of say that to yourself every time, you know, this right here, if you go through this exercise, whenever you get stuck, it'll become a little bit more natural. That makes sense to you. But it's the fact that you can follow along today after like the fourth class, whatever, really the third real class. If you're following along, you're in a good position. Really, just try to make sure that over the weekend now we're gonna do a lot of journal entries just to kind of lock in, and then find what questions we have. Like you asked earlier, when you said, "Well, what if I do this?" That's studying right there. That's good studying. Everybody okay? Yes, sir.
So like, when I was in the horn last night, and kind of like I get the advertising expense, I get that, kind of like to the gym, like the practice, and then I get the account payable. I always say, because like I was doing something in my horn last night, and they're saying he's already been to class, and he's already made a grade in class and everything. He was, as far as I'm aware, I thought every time I would write accounts receipts. 'Cause I thought,
Accounts receivable is if I owe you money.
Yeah, well, that's what I'm saying, that's what I thought I was getting that money back. So like, money's coming to me, so I'm getting that money.
That's a receivable.
That's a receipt. Y'all.
Right.
Like, well, I received, you received that.
That's right.
And then like, that's what I'm saying, but you didn't write accounts receivable, you wrote account payable.
Right, because think about it. You got some advertising from her, right?
Yeah.
Okay, did you pay her cash?
Yeah.
No,
No.
that ain't what it said.
No.
You didn't pay her cash, so
No.
that means you owe her, which means that created a what to you?
A
A liability. That a liability is called accounts payable because I have to pay her.
Right.
That kind of help you out? Now, what if she owed you? I tell you what, if she owed you money, it'd be of what?
I owe you.
Accounts receivable, right? You understand that, don't you?
I mean, yeah.
Yeah, because you're getting the money.
Yeah, they owe me.
Well, you got to pay her too. So that's called an account that you have to pay. Accounts payable. You see what I'm saying?
Yeah. Yeah. Huh? Yeah.
But you understand accounts receivable, right?
Yeah,
I
I
know.
know. That's why every time I wrote accounts receivable, and my screen would light up in red. Dude, that's like the most like heartbreaking things, you know.
That they read, yeah. I mean, especially when you finish and you thought you finished. And
Oh yeah, you thought you
I got it this
right.
time.
Yeah.
Yeah.
Lights up like Christmas.
Hey, but you
No
know
green.
what? That means that when you see it on an exam, because exam is going to be set up the same way. You know, by doing it in there, you kind of get used to the feel of it. You know, that's the same problems, but it's the feel of it. So that's going to be like an automatic indicator. Don't do that at certain time. Yes, ma'am.
Is the exam on the computer on like the?
Exams on the computer. So if you're used to doing it on here, or excuse me, if you're used to doing it on the computer now, it's going to be set up that same type of way. Except for multiple choice is going to be on there, but you know, you can take a multiple choice any kind of way. You know. What's the next one?
Sir. Second.
Perform services of $18,000. Okay, cash from customers we received, and we also received one of those accounts receivable things. Okay, so let's do the easy part first. We set up a whole computer system for somebody, $18,000. We set it up so we earn some what? Revenue. We increase revenue using debit or credit. It's a credit. We increase revenues using a credit, right? Why is that? Because revenues increase retained earnings, which increase equity. Sound good? All right, so that's the easy part. Let's go ahead and knock that out. Usually I do the debits first, but since it has 3 for the first time, we'll do a little bit differently. Service revenue, $18,000. Now, how much did we receive in cash? That's what we earn. How much did we actually receive in our hand? $2,000. $2,000 cash. So how do I show an increase in cash? Debit. All right. Did we pay you all your $18,000?
No.
So that means you have an account receipt, which is a
Liability. No.
asset. There you go. Those two are easy to mix up though, so don't worry about it. You know, you'll get it right by the end, but those are the two that you expect to mess up a little bit right now. Okay? Yes, sir. Yeah, probably so. Now, the correct answer is do it exactly like it's done, you know, when you do it, but probably, usually that's the way you're going to see it, usually. And just even in real, that's the way I would do it, even in real life. So I would say yes. Right.
Even when cash is a credit.
Sir?
Even when cash is a credit, does it come first?
In that case, it'd probably be last. Like we did earlier, like the example that he said, now I know it was a little bit different, we were just kind of supposing, but usually it'd probably be last. But it's in real life, you have that option to do it either way. It just kind of getting used to how it wants you to do it, you know, just for here. All right. Now we're going to pay $400 cash dividend to stockholders. Remember, you own less than 20%, so you're going to receive dividends, okay? You're going to pay that out. Dividends is not a what? Dividends is not an asset, and dividends is not a what? An expense. Dividends is not an expense. Remember that dividends are not an expense, but they're treated the same way because they both decrease equity. So how do I show a decrease in equity? Debit. Sound good? Dividends are not expenses, but they both decrease equity. Because of that, we're going to debit dividends. Please don't put dividend expense. It's just dividends. Okay? And we're going to pay what kind of dividends? Cash dividends. So we need to, in this case, decrease cash, which is an asset, by using a credit. Good. $600? $400. That's $400. All right. Now here come the bills. Pay utility bills for $2,000. I have utility expense, right? We showed an increase in expenses using the what? Debit. Utilities expense. And we're going to pay them using what? Cash. $2,000, right? Sound good? Not that bill. Okay. What about number 10? Now, number 10 refers to part 6, okay? So in part 6, we purchased some advertising on account. So now we're going to have to do what? Pay it, all right? We previously recorded a liability for that, right? How do we show an increase in liabilities? Credit. So to get rid of that liability, I need to do what? Debit. Accounts payable. And we're going to pay it off using some? That's what you earn. But you're going to pay it using cash. For how much?
Is the one on top always going to be debit?
The one on top is always going to be a debit. And that's good. That's kind of like most things, good practice. You may see somebody do something a little bit different, but yeah, the best way to do it, the only way I know to do it is always put your debits first and your credits, second or all together later on. Perfect. I mean, that's a good question though, because sometimes you may see something a little bit different, but that's the way I've always done it, and I believe that's the correct way. Is it $600? Some of that $600 I like. Someone owe me $600. Now we're going to pay $40 of interest from that bank loan. And all this is saying is this right here. Look at your credit card bill. Anytime you owe interest, you have an interest expense. Okay, so how do we show an increase in our expenses? With a debit. And we're going to pay that using cash. I need to let cash stay up there, huh? How much is it? $40.
So it's like, is cash going to be used like this like all the time? Like, you know what I mean? Like, cause obviously like a constant thing.
Let me kind of answer that even in terms of real life. How you pay for most of your stuff? Even whether it's a cash bank card, cash or debit card, money order, you pay for most of your stuff using what? No, not of the three, just that all that is cash.
Yeah.
So pretty much, yeah. Pretty much it's always going to be cash. Now there are other times you may have to use your credit card for emergency, but that's pretty much how it is. And everything is going to go back to cash. That's why it's listed in order of liquidity, right? With cash at the beginning. Everything starts and ends with cash. You need cash to eventually to buy that equipment. Even if you pay for it on credit, you got to get that. Why do you get that equipment? To sell something, right? You may sell it on credit, but eventually they're going to give you some what? Cash. It's going to all come back to cash. That's the whole circle. That's all it is. Okay.
So I don't ever use like equity to buy anything. Like something like, because what is equity? Is what you own, right?
Equity is what I own. So let's say I had a car worth $5,000. Well, I started a business, right? I need some equipment. I put $5,000 in the bank, cash. I have equity of that right there. Now that equity is going to stay there, okay? But this cash, I'm going to switch that cash maybe to buy, I don't know, whatever it is to make stuff for my business. Maybe some lawn equipment, right? Okay, I buy that lawn equipment to go cut your yard so you can give me some what? Cash. When I cut the equipment, when I cut your yard, I've earned cash and I've also earned some what? Equity, which is in particular service revenue, right? So my revenue went up, my equity went up because I used equipment that I paid cash for to get it. So it's all a circle that comes back to cash. So there's a longer way of saying, yeah, you're going to pretty much use that cash all the time, which means you probably will get at least a 50 on the exam, right? Because everything got to do with cash. Think of it that way. Okay, so the rest of it you can just guess on, right? You got to guess your way. You got to think you're smart enough to make a 50 by guessing, right? And then you don't get a 50 just because we're dealing with cash. That's a 75.
I like the outlook. You're really positive.
Man, I got to be, man. All right, now, time to pay my employees $6,400 solid dollars out of your pocket. Not mine, okay? So, salaries, expense, debit, credit. Debit. And how are we paying this? Cash, okay? There it is again. Yes, sir.
So when does a portion of the salary become an account payable?
Or let's say salaries payable. Good question. That's an excellent question. That's chapter 4. But watch this right here. Can I erase this?
Sure.
All right. Today is the 6th, correct? So let's just say we get paid on the 15th. Okay, how much we get paid? Who? You can't pay me $200 a day. I'm not doing the work. $2,000. $2,000. We get paid $2,000 on the 15th of the month. Okay, sound good? All right, now, January 15th just passed. This here is the end of the month. And the next time I'm going to get paid is on the 15th. I ain't going to have no money for Valentine's Day. Yes. Not at home now. So, I have salaries. I work a part of this time, right? So, I have salaries related to right here. And watch this. Just because I didn't get paid here, am I just going to stop working until the 15th? No. But I have some salaries down there as well, right? Okay, now, either way, I haven't gotten paid yet. I'll probably get paid on the 16th. Just thinking about it in a certain way. I'll probably get paid on the 16th. So, right here I have salaries. I did not get paid. A liability, I created an expense, right? So that's a salary payable. Or accounts payable. I know you said accounts payable. That's a salary payable, okay? Now, I have salaries expenses this time, and I haven't gotten paid yet, right? That's another salary payable for every day you go by. Every day you're working on get paid, someone owes you that money. Now, eventually you're going to get paid. And what's going to happen? You're going to get rid of that salary payable and pay, there you go, pay the cash. That is chapter 4. So you are already there by using the same things that we've been using the whole time, okay? We are almost there now. Received $12,000 cash from customers billed earlier. All we know is we're receiving $12,000 cash from a previous accounts receivable. How do I get rid of my accounts receivable? By debit or credit? Credit. And I received some what? Cash. So cash, accounts receivable of how much was that? 12,000? Good right there? All right. And finally, income tax time. After income tax, what? Expense. All right. And we're going to pay it using what? Cash. The same thing that you just asked, though, how much is this right here? 1,500. But the same question you just asked applies here, though. Because you're paying taxes for when right now? For the entire last year. So just erase this just to kind of drive that point home. As of December 31st, you owe, let's just say what, $1,200? Okay? That's an income tax expense, right? But have you paid it yet? I mean, let's say that you owe some money, that's an income tax that's payable. Okay? Then on April the 15th, you may do it before then, but April 15th, you're going to get rid of that liability, right? And you're going to pay it using some what? That's the word for the day. Okay, sound good? Everybody ready? What we doing this weekend? Study hard. See you later.